In 2021, a 23-year-old college student named Alex Kearns opened his Robinhood account and saw a negative balance of $730,000. He believed he had lost everything. Within hours, he took his own life. The tragedy was that the number was a glitch, a temporary display error during an options settlement. He never actually owed that money. But his brain could not process the loss. It short-circuited. And that reaction, that visceral, overwhelming terror at the sight of red numbers, is not a bug in human psychology. It is the operating system. And it is the reason 90% of traders lose money. Today, we are going to dissect the 4 psychological forces that make the market a casino where the house is your own mind. Here is a number that should disturb you. A study by Bry Barber and Terrence O'Dean at UC Davis analyzed over 66,000 brokerage accounts over a 5-year period. They found that the most active traders, the ones who were most confident in their abilities, earned an annual return of 11.4%. The market average during that same period was 17.9%. The more they traded, the worse they performed. And yet, they kept trading. This is the overconfidence bias. It is the deeply wired belief that you are better than average, that you see patterns others miss, that your gut feeling is a signal rather than noise. 74% of fund managers believe they deliver above average performance. Mathematically, that is impossible. But psychologically, it feels absolutely true. The overconfidence bias is amplified in trading because the market occasionally rewards random decisions. You buy a stock on a hunch, it goes up, and your brain says, "I knew it." This is called self-attribution bias. You take credit for wins and blame external factors for losses. Over time, you build a fictional track record in your own head that says you are a market genius. You are not. You are a pattern recognition machine running on confirmation bias. The practical takeaway is uncomfortable but simple. The less you trade, the more you make. Barber and O'Dean's research is unambiguous. Activity is the enemy of returns. Your confidence is not your edge. It is your leak. In 1913, at the Monte Carlo Casino, the roulette ball landed on black 26 times in a row. Gamblers lost millions betting on red, convinced that the streak had to end. It did not care about their conviction. Each spin was independent. The ball had no memory. This is the gambler's fallacy, the belief that past random events influence future random outcomes. And traders fall for it constantly. A stock drops for 5 days straight, and you think it is due for a bounce. Bitcoin crashes 40%, and you buy because it has to come back up. The crypto crash of 2022 wiped out $2 trillion in market value, and retail traders kept buying on the way down, convinced each dip was the bottom. Many of those buyers are still underwater years later. The flip side is the hot hand fallacy. During the meme stock mania of 2021, traders watched GameStop rise from $4 to nearly $500. They saw others making life-changing money and believed the momentum would continue indefinitely. The stock eventually crashed back below $30. The traders who bought near the top were not stupid. They were human. Their brains are wired to see streaks as meaningful, to project recent patterns into the future. A landmark study by Daniel Kahneman and Amos Tversky demonstrated that humans are fundamentally incapable of intuitively understanding randomness. We see patterns in noise. We see intention in chaos. And in the market, that instinct is weaponized against us. The takeaway, when your gut screams that a pattern must continue, or must reverse, that is exactly when you should do nothing. The market does not owe you a correction. It does not owe you a trend. It owes you nothing. Here is something the trading apps do not advertise. Every time you open your trading app and check your portfolio, your brain releases dopamine. Not when you profit, but in anticipation of finding out. This is the same neurological mechanism that makes slot machines addictive. The variable reward schedule. Sometimes you are up, sometimes you are down. The unpredictability is what makes it irresistible. A 2020 study published in the Journal of Behavioral Addictions found that day traders exhibit neurological patterns strikingly similar to problem gamblers. The compulsive checking, the inability to step away, the escalation of risk after a loss to chase the feeling of a win. These are not character flaws, they are chemical dependencies. Robinhood understood this. The confetti animation that played when you made your first trade was not a celebration, it was a trigger. It was engineered to associate trading with reward, to create a behavioral loop that kept you coming back. They eventually removed it after public pressure, but the underlying design philosophy, make trading feel like a game, has not changed across the industry. During the 2020 pandemic, brokerage apps saw a massive surge in new accounts. Millions of people, stuck at home, bored with stimulus checks, started trading. Not because they had developed sophisticated strategies, because the apps made it feel exciting. The dopamine hit of watching numbers move in real time was more entertaining than anything on Netflix. The takeaway is structural, not motivational. Delete the app from your phone. Check your portfolio once a month at most. Automate your investments. Remove yourself from the dopamine loop entirely. You cannot outthink a chemical addiction through willpower. You have to redesign the environment. In 1985, economists Hersh Shefrin and Meir Statman identified what they called the disposition effect, the tendency for investors to sell assets that have increased in value while holding assets that have decreased in value. In other words, you lock in small wins and ride your losses all the way to the bottom. This sounds irrational. It is irrational. But it is also deeply, predictably human. The explanation lies in prospect theory, developed by Kahneman and Tversky. Losses feel approximately twice as painful as gains feel pleasurable. A $50 loss hurts more than a $50 gain feels good. So when a stock goes up, you feel a desperate urge to lock in the gain, to make the pleasure real before it evaporates. And when a stock goes down, you refuse to sell because selling would make the loss real. As long as you hold, it is just a paper loss. It is theoretical. It does not count. This is how people turn small losses into catastrophic ones. During the 2008 financial crisis, millions of investors watched their portfolios drop 20, 30, 40% and held on, waiting for a recovery. Some stocks never recovered. Lehman Brothers went to zero. Bear Stearns went to zero. The paper loss became a permanent one. Terence O'Dean's research found that the stocks investors sold, the winners, outperformed the stocks they held, the losers, by an average of 3.5% over the following year. People were systematically selling the wrong stocks and keeping the wrong ones, not because of bad analysis, but because of loss aversion. The takeaway requires a system, not a resolution. Set stop-loss orders before you enter a trade. Define your exit criteria in writing when you are calm and rational, not when the market is moving and your amygdala is screaming. Your future panicked self cannot be trusted. Your current rational self must build the cage in advance. Let us put this together. You enter the market overconfident in your abilities. You see patterns and randomness and project them forward. You become chemically addicted to the act of trading itself. And when you do trade, you sell your winners too early and hold your losers too long. This is not a recipe for losing money. It is a machine for losing money. And it runs on the exact same cognitive hardware that kept your ancestors alive on the savannah. The pattern recognition that helped them spot predators now makes you see trends and noise. The loss aversion that made them protect scarce resources now makes you hold collapsing stocks. The dopamine system that rewarded exploration now chains you to a glowing screen. The financial industry knows this. Every gamified trading app, every breaking news alert, every red and green color scheme is designed to exploit these biases, not to help you trade better, to help you trade more. Because every trade generates a commission, a spread, a fee. Your activity is their revenue. The 10% who consistently make money in the markets are not smarter than you. They have simply built systems that protect them from themselves. They automate, they diversify, they set rules and follow them mechanically. They treat investing as boring because boring is profitable. Here is the truth no trading guru will tell you. The greatest edge in the market is not a strategy, an indicator, or a piece of insider information. The greatest edge is self-awareness. Knowing that your brain is working against you is the first step to building a system that works despite your brain. The 90% do not lose because they are foolish. They lose because they are human. And the market is the most expensive place in the world to be human without a plan.